Peter, perhaps can we start with you? What is it that a bailiff does on behalf of your clients, and maybe could you just describe who your clients are and perhaps your mix of kind of personal and commercial?
As a joke, I used to say I steal cars. To my girlfriend's mother, I said I was a private consulting assisting financial institutions with their accounts receivable and debt collection. What I do is we assist various financial institutions and leasing companies, banks, with the recovery of their assets if it was an asset pledged loan. So versus a line of credit, some of them would be a collateral-based loan. And as a bailiff, we're the repo guy that you see on TV backing up with the pickup truck and stealing cars. That's one half of our business. As I have developed our business through the years, I do a lot of work with financial institutions on the recovery of some commercial loans and recovery of smaller business assets, your small business loans. You would see them as the franchises of your Subway or something like that. I would assist Sands and Associates and various trustees and receivers with the recovery of those assets and the remarketing of them. The court bailiff side is in the BC government, used to be the Sheriff's Department, and they privatized that. So we go out and we assist now and enforce court orders. So that's your judgments. It's very funny that we're talking about BC Securities. We do all now the recovery work for the BC Securities Commission when they get judgments against some of these Ponzi scheme people. Now that they have some funds in a budget, we have actively been pursuing some of those people, trying to locate any assets that might be recoverable under the files. So those would be the court-ordered seizure and sales, writs of seizure and sale, and one of the other, not as glorifying avenues we do would be removing residential tenancies. And that's not a nice fuzzy job, but we would be the guys that would come in when they don't pay your rent and remove your tenant from the property under the BC Residential Tenancy Act. So that's what we do. And right at the moment, our portfolio is mainly on the commercial side and the court bailiff side. We do a little bit of the registered personal debt, but not as much. There's a couple of larger corporations that specialize in the car loan aspects that are nationwide. Thank you.
Great. And Blair, could you just briefly outline kind of what an insolvency trustee does?
Yeah, sure. So my title is a licensed insolvency trustee. And I know we have a lot of U.S. residents here, but even a lot of Canadians don't have any idea what that means. A couple years ago, we changed our name from trustee in bankruptcy to licensed insolvency trustee, or the government forced us to change the name just to make it a little less scary and encourage people to come forward when they need debt help. So what I do as a licensed insolvency trustee is I meet with individuals and small businesses primarily. Our practice is about 90-95% individual and small businesses. I help them understand their legal options for dealing with their debts. So if it's a case they got way too much debt, they're insolvent, which means their debts exceed their assets, they've got a negative net worth, I help them with two main remedies. And if you were in the US, you'd see bankruptcy lawyers advertising like crazy, bankruptcy attorneys. You don't see that in Canada because anybody that needs to file personal bankruptcy in Canada, they have to use the services of a licensed insolvency trustee. So about 1/3 of people that come to see me, I explain to them, here's how a bankruptcy works. It's generally not as bad as you think. It's not a life sentence. Most people are done with it in 9 months. I'll go into a little more detail if we have time here, but I explain to them how bankruptcy can get them back on track. 2/3 of what I do is helping people avoid a bankruptcy, which is doing what's called a consumer proposal. And in a consumer proposal, we take a look at what's the worst case. If this person files for bankruptcy, they got $50,000 of credit card debt, probably none of that's going to get paid back. Person doesn't want to file for bankruptcy and the creditors would rather get paid something, so we do what's called a consumer proposal, where most of the time people pay back about 30 cents on the dollar. They make payments over a period of up to 5 years, no interest, no charges, and they avoid a bankruptcy that way. So that's an option that's taken off in the last 10 years. Previously it was maybe 10-20% of the business. Now it's about almost 60-70% of people doing repayment plans through consumer proposals.
We're going to have a chart on that. Fantastic. What I'd like to do is I just want to throw up a couple charts. I know you guys probably can't see this too well on your side, but a couple of charts here. It's interesting to me looking at the kind of consumer credit landscape, particularly here in BC. We have an unemployment rate, as we mentioned earlier, that is near the all-time lows and about a point and a half below the national average. If we look at consumer insolvencies in BC, they're up a tiny bit off of the lows, but I mean, really, we could call that still effectively at the dead lows, right? But we also know that if we kind of back out to the macro level, we have extremely low household savings rates. We have household debt service ratios here in Canada that are at 10-year highs, even though the overnight rate's a third of what it was then. And I think if we look at some of the indicators that might point to consumer stress, and in particular, I'm of the view that, and perhaps you can correct me on this, that people don't just wake up one day and default on a loan. The first thing they're going to do is they're going to tighten their belt, right? And they'll stop eating out, they'll do whatever they need to do. And so often we find that retail sales are a pretty good leading indicator of some sort of consumer stress. And what we see here in BC is that monthly retail sales have definitely flattened out after a period of sustained rising since really the early 2000s. Big purchase items often come under pressure. We see new auto sales in BC have rolled over quite hard recently. And so it begs the question, and I should also mention, in Ontario, so right now, consumer insolvencies last month in Canada were up about 5% year over year in terms of filings. But if you look at the dollar volume of liabilities, they were up almost 20%, which tells us that bigger files are going delinquent. And when we look at where the source of the stress the source is, first of all, in Alberta, where you might expect. So dollar volume of liabilities in those filings up 55% year over year. But also in Ontario, where it was up 30% year over year. Now, curiously, in BC, it's dead flat. And so I guess my question to you guys would be, you know, on the charts here we have sort of the good news story, low unemployment, very low delinquencies, but some flashing red lights. And so which of those two charts sort of resonates right now in your own business?
Well, maybe I'll go ahead on that. The gentleman this morning, I think his name was Sat, he was talking about foreclosures, and I can totally echo that scenario. So essentially, anybody that's made a mistake, that owned a house in BC, but they've made a mistake, they've overspent on their credit card, so on and so forth, I don't see those folks because essentially they just refinance the property, they take out the equity every few years, and that's that. So I haven't seen a foreclosure in a number of years now, and we're the biggest firm in BC for what we do. I'm one of 8 trustees there, so maybe other trustees see them, but I would know if we're foreclosing or having foreclosed a ton of properties. It's just not happening. So people are just basically, and it breaks my heart a little bit. You'll see people, 20 years ago, they bought the property, maybe it was $50,000, $100,000. It's worth 1 point or 2 point whatever now, but zero equity. Zero equity because every time it comes up, pull out all the equity, put it to work for you for consumption or whatever. So what I've seen is that started to come to a halt now, that people aren't able to refinance. I have people walk into my office. I had a police officer and a mortgage broker just a couple weeks ago, and you can imagine the combined income is definitely under 200 or somewhere thereabouts. They were over $2.5 million extended on a property they had bought. They had renovated. The renovations went over, went over budget, and they were incredibly overextended. Not much I can say to them other than, well, you've got to start unwinding your assets, and I'll see you when there's a shortfall at the end of it. So I think there's a great unwinding that has to happen of folks that have no room to maneuver anymore, and they had really planned on the market continuing to go up, and now that it's stopped doing so, especially over the $2 million mark, I'm expecting to see a lot more of those folks that will come in with their house into foreclosure, them in default, but the house is absolutely the last thing to stop getting paid. The cell phone is number one, the tightening the belt, the credit cards, they'll move money around like crazy to try to get the mortgage paid every month because no one wants to be foreclosed to have to lose their house.
And can you just speak to your volumes? I mean, are you seeing an uptick in people in your office right now? Can you speak to that?
Yeah, no, apologies if someone spoke to me already. I've said this, but we've been around 30 years. My busiest January was this January, my busiest February, my busiest March, and April. Every month this year has been the busiest month we've had in 30 years of new inquiries. So our filing volumes year over year are about 20% up, so we're outpacing the market a bit and we have expanded. But the new inquiries, I can barely get the phone answered these days. A lot of people, and some of them, again, I'm saying you're way over leverage, sell the house, let's talk to you once that's done. But a lot of the time it's folks that really need the help and they're just reaching a breaking point.
Great. Peter, anything to add there?
No, I have to echo that same. Blair and I were talking about it before. People have been, through the years of this up market, they've just been reborrowing on the equity of their home to satisfy the the foreclosure rate. So every time the refinancing came, they would, draw a little bit more out. But year after year, there was always a 5% lift or a 10% lift, and they were drawing that out either for consumables or for debt servicing. And now we have these mix, so some people there were using that. But now, with the B20 tightening and everything else, the market becoming no more equity, we're seeing our business a little bit more people. The phone's been ringing, as Blair says, and it's, if we saw a 1% increase rate in the mortgage rates, I think we'd be over the top.
Fair enough. And you had an interesting comment when we were speaking earlier about you've noticed an uptick in repossessing of some luxury vehicles. Peter, do you want to just speak to what's driving that trend?
Yes. I want to be very careful how I say this. There's a group of people that don't seem to put away money for a rainy day, and when the market right at the moment is getting a little slower in real estate, stock market, etc., those people that have a tendency to go out and lease a Lexus or something, a Tesla, those now are becoming one of our more increased volumes of people that we're having a look at, having a visit and maybe discussing about their collateral.
So we're talking realtors right now, is that?
Not in this room. Yes.
No, it's look,
overall, the real estate market here has been slow, so some people that may be over-leveraged are having to give up some of the toys. And stockbrokers, et cetera. The market's been very slow for that as well. So.
Interesting, okay. Blair, I just want to put up the start. You mentioned, I'm sorry, I apologize. You probably hear. It's on the chair. Okay, so interesting dynamic here. The red line is consumer proposals. The blue line is bankruptcies. And you can see in BC exactly what you just said here. Almost no bankruptcies to some extent, it's happening nationwide. There's a story, bankruptcies generally are falling, but consumer insolvencies are trending up quite sharply. And what's driving that specifically? If you could.
Yeah, there's a few factors. So part of it's cultural. So if you were to go to Quebec, nobody does a consumer proposal. In Quebec, the bankruptcy rate is way higher. It's just not ingrained into the culture. If you go to Atlantic Canada, there's income. Income's a little bit lower, so there's very fewer proposals. You have to have the ability to service the debt. I think out in BC, there's two big factors. So part of it is people are now aware of consumer proposals. So the amount of times when I really love my job, because I can see people, their jaw drop, their eyes wide open. How do I not know about this? Instead of, paying off for 150 years my minimum payments, I can make an offer of 30 cents on the dollar, no interest, you get a trustee appointed, I stop all the calls and I deal with them. So I think it's a case that the word is getting out more and more, especially within BC, that this is an option for people. And the second part is that there's the income there to support it. So the vast majority of people that I see, they're working. They're not making tons of money. They're probably between $2,500 and $3,500 a month after taxes, but they've got some disposable income, but it's not enough disposable income to actually pay the debt service cost because their cost of living has increased. So when I became a consumer trustee about 13 years ago, I was corporate prior to then, the first people I saw in BC, they're maybe spending about a third of their income on rent, and that's pretty typical. About a third of your income should go to rent. Everyone I see now is over 50%. So I'm talking people $2,200 after-tax income, $1,500 goes for rent. At that point, there's not much you can do other than go into debt, and still the stigma of bankruptcy, it's there, it's deep, and there's something to it. You never want to just throw up your hands and give up. So the ability to pay something back, pay what you can afford, people take a whole lot of pride in that. I don't think they hesitate so much from filing anymore because they know it's an option, and they know they're so squeezed from a cost of living in BC that they got to do something.
Fair enough. And maybe just comment on this notion that in Canada the bankruptcy laws are extremely creditor friendly. And can you just comment on that, and in particular just explain this idea of surplus income bankruptcy and what happens when you're below that threshold?
Yeah, so originally when we talked about that question, Ben, I think you used the word, they're a bit draconian, the bankruptcy laws in Canada, and I think they're the opposite. I think they're incredibly consumer friendly and people don't know that much about them, but there are some really counterintuitive, counterproductive parts to bankruptcy laws, and one of them, as you hit on, is called surplus income. So to give a very quick crash course, if someone files for bankruptcy, there's two ways a bankruptcy can go in Canada if you've never been bankrupt before. It can last for 9 months, which is an incredibly short period of time. Most people think it's 6 or 7 years, but no, 9 9 months of bankruptcy can be over with, or it can last for a year longer than that, 21 months. The only difference is not the amount of the debt, not who it's owed to, not how you conducted yourself, nothing like that. It's what's your monthly income. If you're considered low income, which means for a single person you're earning less than roughly $2,200 per month after tax take-home pay, regardless of the amount of debt, you can be out of bankruptcy in 9 months. If you're earning more than the low income guidelines, so more than the $2,200, government rewards you for an extra year in bankruptcy, and instead of just paying the cost of the bankruptcy, which is $1,800, you pay based on your income. You pay 50% of every dollar that exceeds $2,200 over a course of 21 months. So part of this drives people to do proposals, so that's part of it. If bankruptcy is going to be more expensive, they might consider a proposal instead, but it also drives people not to go have the best year of their life. Forces them not to take an overtime shift or perhaps not take a promotion to try to keep their income as low as possible, so they might be done to bankruptcy in 9 months. So there's some public policy considerations there. If someone's low income, let's get them in and out of a proceeding that's not meant to take the rest of their life, but it doesn't really reward folks to go out and spend an extra year in bankruptcy. It does drive them to do more proposals, but it's sometimes viewed as unfair. Wait, I earn more money, I get to spend more time in bankruptcy and pay more debt back? Well, yeah, you do, and no one said life was fair, I guess.
And so just to be clear on this, that surplus income threshold is scaled based on the number of people in the household?
Yeah, so family of one is 2,200, all the way up to 7 plus is probably 4 or 5 grand or so. Yep.
And that's net. And so just to be clear, if I fall under that surplus income threshold, 9 months later, every dollar that I owe is fully discharged, zero recovery to the creditor.
Yeah, and let's be clear about this, because again, I know some U.S. folks here, and a lot of us, we get our news from the U.S., so the amount of people that come in thinking you can't discharge income tax debt or you can't discharge student loan debt, and I understand you can't in the States, but in Canada, you absolutely can. If you've been out of school for more than 7 years, a student loan is the same as every other debt, and income tax has no special status. There's some carve-outs if you're over $200,000 of income tax debt, which is a lot. You got to go sit before a judge, but typically it still gets discharged. But yeah, all of your debts, all of your unsecured consumer debts can be discharged.
And that includes any shortfalls on real estate becomes unsecured, gets rolled into debt, fully discharged.
Absolutely. So, CMHC is a creditor that I see quite often because of the insured mortgage. They keep the mortgage holder whole, and then CMHC files a claim in a bankruptcy proceeding. But yeah, absolutely, a shortfall would not survive a bankruptcy. And
so just to be clear, what percentage of your clients fall under that threshold?
Well, I think nationally the research I've seen is almost 80%.
So 80% of bankruptcies have zero recovery in Canada.
Very low recoveries, 9 months. Again, most people who would have a higher recovery end up doing a proposal, but the vast majority of bankruptcies, no recovery over in 9 months.
That's interesting. Now,
it is.
In terms of, let me put on my devious hat for a minute. Let's say that I own my own business, and so I get to set what I pay myself for my corporation.
Right.
I mean, is there any way that, can I just pay myself at that threshold, or who's monitoring that?
Yeah, the trustee should be monitoring that every month. So if you're in bankruptcy every month, you'd be submitting a statement of income and expenses, and you do both sides if you're self-employed, and theoretically you should be getting a wage that's commensurate with the services you're providing. Myself as a trustee, how do I know what services you're providing? I might look at, your last couple of years' tax returns. Well, you were earning $250 and now you're earning $20. What's the difference? If you've got a good explanation about it, how can I go much further? What's interesting too, and it's really counterintuitive, I thought the first day I was a trustee, creditors are going to be so involved. Remember the first couple statements of affairs, I was seeing, credit card companies in here for 70 grand, 100 grand. They never ask a question. I very rarely get any questions to examine a debtor, to ask about their conduct. They just move on. So yeah, the microscope, it's there a little bit from the trustee, but if somebody's low income, over a period of 9 months, they're going to pay bankruptcy fees of $1,800, and I've got to do the entire bankruptcy for that. How much can I really spend auditing you month to month if you want to deceive me? Right. Bankruptcy is based, and this is exactly from the law, it's based on the honest but unfortunate person that needs to turn things around. So it's based on the honest and unfortunate person. If someone wants to deceive a trustee, I'd like to think I'm skeptical, but maybe they get one past me.
Interesting. And so I have to ask you, you must see some files or some folks in your office where you look at them and you go, who in their right mind would lend to this? This was clearly a disaster waiting to happen.
Many, yeah.
Well, so let me ask you, who are the lenders on those files, on those particular ones where you're like, wow, this is a disaster?
Oh yeah, if there's one for sure, it's Canadian Tire. So I almost joke around the office here. Anybody got a file that didn't have Canadian Tire today? No? Okay, it's a Wednesday. So yeah, Canadian Tire Bank, almost always, sometimes as small as $5,000, but often 10, 15, even more than that. So that's the credit card they'll just throw to you when you're in Canadian Tire. That one's big. The government, obviously, an involuntary creditor, so that's not fair. They didn't ask to loan the money, but many self-employed people, when suddenly they can't afford to pay the rent anymore, they stop paying the GST or they stop paying their income tax. Realtors are probably the number one profession that I see with a lot of income tax arrears because it's based on them continuing to sell houses and paying off the taxes on the old one. Once that stops, some realtors have a really tough time catching up on the tax arrears. I know that the past panelists were saying that credit ratings can be very predictive, and I think for some basis they can, but it's incredibly easy to game a credit rating. People can go from 0 to having a very solid credit rating in about 2 years, and that solid credit rating will allow them to borrow way more than I believe they ever should be able to, and I just see it again and again.
And I got to ask you, what share of the people that are filing some sort of an insolvency with you are current on their debts when they come to see you?
Almost everyone.
That's amazing.
Yeah,
That's
no.
amazing.
Upwards of 70% of people that file bankruptcy, perfect credit. I have people walk into my office, I got my credit, it's over 800, and sometimes I can see they're a little bit humorous, so I'll be like, okay, how's that working out for you? Yeah, 800 credit, so you got great credit, just go to the bank, borrow this money. Oh, well, the bank won't loan me any money. Well, so this perfect credit rating is not really worth much, is it? No. So the only way you'll keep that perfect credit is if you pay everything off over time, pay all the finance charges. So we have a bit of a realization saying over the next 5 to 10 years, you could kill yourself, keep that perfect credit, and maybe pay it off. Or you can take a hit, make the better decision for you. The creditors will have to take a hit, but it's Canadian law. I didn't write the law, I'm helping you use it. And again, not to absolve anybody of personal responsibility here, but this is the type of calculation that people are making. They're so far indebted, and they're suddenly learning more and more about the insolvency system, allowing them to get back to zero.
Amazing, amazing. Okay, Peter, one for you here. You've been in the industry now for 30 years. You've seen some cycles. I'm just wondering if you reflect back on some previous cycles you saw, what did you see anything that sort of predicated that? Were there certain things, that signposts that suggested to you that the cycle was turning, and are you seeing any of that right now?
Well, in those 30 years that I've been here, I've seen a decrease of interest rates from the day that I got in. They've been plummeting. Sure. I got in when it was almost 18% interest, and now we're at, 3 and 4. Interest rates were reflective on that, and so was delinquency. Gentleman from the Canadian Western Bank, delinquency rate used to be around 3 to 4% for financial institutions. They're down now to 1% for consumers, or even below. I think the trend now, though, we're talking about the phone starting to ring. I'm getting more people making some more inquiries about our services. Because there is no more equity in the home that they can be borrowing the money from to get themselves out of trouble. So I think we could be in, if I said before, if we go up 1 to 1.5 points of an interest rate on mortgages, Blair and I are going to be extremely busy, and I think we're on the verge of that. I think the Bank of Canada, one of the reasons they didn't raise it was they realized right at the moment that with the amount of household debt, if it does go up another 1% to 1.5%, we're going to be inundated with bankruptcies, major foreclosures. The housing market could go very, very soft because we're going to have foreclosures out there with people trying to grab them. Could be like the U.S., maybe not as harsh, but I think we're coming back into a cycle of maybe some higher delinquency rates above 1. It used to be a joke, if your percentage rate, your delinquency is below 1%, you're either got perfect clients, or your lending policies are a little too strict, where they weren't lending out the money because banks got to lend out the money to make money. So, but I think we are going to start seeing the trend of we could be a little busier with higher foreclosures and a busier term.
Okay, questions?
Yes. I have a quick question, a little bit of cognitive dissonance relative to one of the past panels in regards to the mortgage brokers. If your maximum loan to value is supposedly 80%, you guys shouldn't even have a job. So, maybe your observations over the years, you probably talked to a lot of these clients and such. how big is their mortgage relative to the value of their house by the time you guys show up on the doorstep?
Some of them are as high as 90 or greater. The B20, though, is what caused a lot of some of the refinancing issues, where they could be able just to refinance and keep that going, where they can't anymore. So that tap is shut off. And the equity in the home is no longer there. They were getting a 5 to, in Vancouver here, you could get anywhere from a 4 to a 7 to an 8% lift per year in your home value, which was enough in 3 or 4 years to, when you had to refinance, that you still qualified. That's not happening anymore. So yes, we do see them maximizing to the current home value of what their debt is.
Yeah, I've talked to people all across Canada about the difference between the U.S. and Canadian housing markets. And one of the things that keeps coming up is in the U.S., they have the ability to walk away from their homes in the crisis in 2009. And I researched the numbers. At one point, 30% of all homeowners in the U.S. were going to walk away from their mortgage. And even today, 10% of all the U.S. homeowners are under mortgage, but they can't pay their mortgages. And so the thesis that people have in Canada is, well, yeah, but in Canada, they can't walk away. So therefore, there won't be a housing crash because they can't walk away from the mortgages. But it seems to me that coming to see one or two people, they could easily walk away from their homes. So you comment on that?
Yeah, I think it's right on point. I think it's a false sense of security to say that, the shortfall is going to follow you, and you're going to really have to deal with it. It is if you have assets, for sure. If you've got some free and clear assets, that this shortfall, they can go and put a charge on another piece of property or an investment or some asset that you have that's not exempt, meaning out of the reach of creditors. But absolutely, most people that I see, if they've just went through a foreclosure, they probably got no other assets. Most people think if you go bankrupt in Canada, you lose everything. It's generally the reverse is true. You generally keep everything, so most people think I take their car. No, there's an exemption for a vehicle up to a certain amount. Most people think they lose their tools of the trade, their clothing, their furniture, all that stuff. Most people keep almost everything, including their RRSPs. So this person who, you think you might be well covered, they got $500,000 in their RRSPs, that person could go into bankruptcy, and as long as that money wasn't just put in there in 12 months ago, it's fully exempt, you wouldn't have any claim on that whatsoever. So I think it can be a bit of cold comfort saying, it's recourse and people will never walk away. If people have very little to lose, they would walk away, I think.
Is there some rules about, like from what we're hearing in some of the data, just seems to be a disconnect. So can you walk us through, if these are like stats CAD numbers or something, can you walk us through when someone comes in your office and says, okay, let's go ahead with the proposal, when does that actually get registered in the data?
Let me answer that. So you're looking at February data? That's the most recent that we get, and this is actually from the Thank you. The Office of the Superintendent of Bankruptcies. It is actually a federal agency, and they're the ones that produce the numbers, including the dollar volume of liability. So it's all government, but it does lag badly, which is why this is an important conversation to have. So.
Can you take, or when you look at the U.S. example, a lot of the states were actually full recourse. The reason the banks didn't go after someone who can't afford to pay is the cost of doing that. Can you just talk about the cost from your client's perspective or the bank's perspective and how that might be changing, especially now that the market has slowed down dramatically? They're now incurring, if they're doing a short sale, the taxes, the fees, and things like that. And when we looked at mortgage, the U.S. breakage would have been 10 to 20% of the home value or the loan value. Can you just talk about it from that perspective?
I don't think I have a huge insight into that. Peter, do you have much insight on foreclosure costs? I
No.
can deal with them once it's happened.
Yeah, both of us are the people that would execute, but not the lawyers that would do it. But I would say your numbers are fairly correct, because you're going to have real estate fees, your lawyer's fees. So I would say 10% of the sale price would be very close to in Canadian. And then once you get a default judgment, the cost of enforcing that, if they've lost their home, we would call it here in Canada a dry judgment. So it's going to be registered on title, or it's going to be registered against you. But if you've got no assets, we can't seize anything. So it's pretty well a bad debt. And that stays with them for 7 years, but then they could go see Blair and get it washed away. So But you can't get blood from a stone.
Yeah, and just building on that, so let's say there was a shortfall and the creditor decided to pursue the individual, well, they'd have to serve him with papers, got to find him first. Then you got to take him to court and get a judgment against him. You'd win, but it costs money. Then you got to figure out how you enforce the judgment. At any step of that process, they can see a trustee, everything stops dead in their tracks. And generally, creditors know that. So if 10,000 people owe money, all 10,000 are going to be threatened with a lawsuit. Who actually gets sued? 1 out of 10,000. It's the person who's got assets, who's maybe got a job they've been at for 30 years, they're never going to quit. The self-employed person who's got very few assets would never get sued because it's too easy for them to make the judgment unenforceable. Or again, they'd go and pick the escape valve and go and call a trustee.
Jeff, you have any question?
I was going to say, at this point, we used to have estates and trusts in my group, PD, and we used to budget for about 12 to 15%. We have equity redemption periods for BC and Ontario, so there's a chance for the client to get their equity back, redeem themselves. It's usually a 6-month process to then capitalizing all that interest costs, legal costs, you have the real estate commissions, all those kinds of things. Also, an interesting thing just to note, because everyone thinks about, in Alberta, we don't have recourse. It's just a security. So, interesting enough, the province that's got the most distress in the country, we haven't seen a huge rise in foreclosure activity yet. There are 4 or 5 million events out there. So even though they can walk away and you can't sue them for the difference, it's an attitude about the asset, I think, that exists.
Interesting.
And to build upon that, in BC, collateral debt is sewer seas here. Mortgage debt is enforceable, but any collateral or consumer debt is sewer seas. You're done as soon as you pick up a collateral, so a car or something like that, you're finished. You realize you're finished.
I just want to repeat it to the folks, in case the folks in the back didn't hear. The question was basically, what is the cost of going and seizing some of the assets? And the answer was kind of 10 to 15%. So a lot of frictional costs involved. Maybe one last question? If there's, yeah, Dan.
In a minute or two, could you just give us an average example of, let's say, somebody owes $1 million including mortgage, who loses money at the end of a bankruptcy in terms of creditors?
Yes, we'd have to make an assumption whether they're going to be keeping the house or not keeping the house. So let me make a simple assumption. Let's say it's worth $1 million, got a mortgage of $980 against it, and they want to keep it and they need to continue to pay it. Okay? So if that person files for bankruptcy, the secured creditor, the mortgage holder, they're going to continue to get paid. There's no loss to them, and that's the vast majority of cases where I see real estate, they just continue to pay on the real estate, and the secured creditor doesn't really have to take a hit. So they file for bankruptcy, and I'm going through and evaluating all of their assets. Let's say they've got no special furniture, no great tools, nothing crazy that's not exempt, but they got this $20,000 of equity in the house. Well, the province of BC has put an exemption of up to $12,000. So if someone files for bankruptcy, the first $12,000 of home equity is free and clear. If I have to sell a house in a bankruptcy after the secured gets paid out, I would have to pay them the first $12,000, which sometimes happens. So right away, they're in a better position if they're in a bankruptcy because they're continuing to pay their mortgage, but they're not paying the other unsecured debt. So let's say the other unsecured debt was, say, $50,000, for example. If they go through a bankruptcy, and let's say it's a single person, they're earning $3,200 per month. I explained to you before that the low-income guideline is $2,200. They're above it by $1,000. So every month in a bankruptcy, they're making a $500 payment. So over the course of 21 months, they will have paid in about $10,500. There'll be some costs of administration on that, maybe $5 or $7 grand, something like that, and the balance would get paid out to the unsecureds. So in that example, which is the vast majority of cases, secured creditor takes no hit whatsoever because the mortgage is continued on with. The unsecured essentially take a big bath. Most of the time it's pennies on the dollar, maybe 10 or 20 cents, which is why in that situation the person might be looking at, well, if I'm going to go into bankruptcy and pay 10.5 over 2 years, why don't I offer them a proposal? I'll pay 15, but I'll do it over 3 or 4 years. I'll avoid the bankruptcy. The unsecureds are very likely to accept it because it's their best possible recovery, and the secured creditors, they don't even have a vote in that proposal because they're not compromised in any way. On the other side, if they were walking away from the house, well, house would get sold, whatever was left after the secured creditor was paid out. If there was a shortfall, they'd have to basically eat all of the shortfall. If there was any excess after the secured creditor is paid out, I pay the individual their $12,000 exemption, and then the balance goes to get distributed amongst the unsecured creditors. So apologies if that was a bit complicated. Does that make sense to you? Okay.
What percentage of unsecured creditors would be financial institutions?
Oh, vast majority of it. Yeah, almost all, always the big banks. I'm seeing payday lenders more and more, and they're the worst of debts. We're talking 500% interest. You don't see one, you generally see 5 or 10 with the same client. But it's almost always large institutions. Now, mind you, the scorned ex-wife, ex-husband, they're at the bane of my existence, because you can imagine someone trying to use the trustee as a weapon. Did the ex-husband tell you about all this? No. But for the most part, it's the large financial institutions.
All right. Thank you, gentlemen. That was fantastic. I think we're
Thank you.
Okay.